REC has claimed to post the best ever quarter this time, and to talk about it, I have Chairman and Managing Director, Mr. Vivek Kumar Dewagan ji. Mr. Dewagan, welcome to ET Now. My first question to you is that what is contributing to this bottom line?
The clear-cut business strategy and sound management practices adopted by REC are leading to this tremendous growth in REC. We are committed that in line with the energy transition ambition of Government of India, will be giving more focus to financing the renewable energy projects. It's our target to increase our renewable energy portfolio by 10 times in next 7 years, from 30,000 crore to 3 lakh crore by the year 2030. In addition to that, Government of India has allowed us to diversify into non-power infrastructure and logistics also. That has also given us additional space to grow, and hope that with a clear-cut focused initiative, and we are also targeting the good asset quality. In addition to that, we are targeting that our NPAs should become zero by the year 2025.
Now, this is something being net zero by FY25. You have to take efforts from quarter on quarter, and as you mentioned, by 7 quarters consecutively, there is no fresh NPA. What is the strategy that is working, and what is the target for current year per se? How are you pursuing that?
Yeah, as of today, we are having 19 stage assets, for which we already made provisioning of about 70%. Out of this 9 assets we are planning to resolve in the current financial year. 4 projects we are at the verge of resolving, and another 5 projects will be able to resolve in the current financial year itself. Remaining 10 projects are also at different stages of resolution, and we are 100% confident that we'll be able to resolve all these assets by the year 2025.
Right. There are other parameters as well where you have performed well, especially net interest margin, which has been increasing. Now, I want to understand that on a constant basis, you believe that this kind of growth is sustainable. What is your year ahead target?
Yes, I'm 100% sure that we'll be able to sustain this momentum. Our net interest margin is poised to grow actually. At the H1, our net interest margin is 3.41, and we hope that by the end of this financial year, our net interest margin will go beyond 3.5. It may touch even 3.6% also. And we are able to hold on to our spread, although we are sanctioning a lot of renewable energy projects where margins are not much, but the decrease in margins of renewable energy projects we are planning to compensate by the volume of the project that we are sanctioning.
Right. You also mentioned about asset under management, which has increased 20% per se. What kind of increase is this? Meaning that if you can explain that, are there more availments, or it is only disbursement which has grown?
In fact, on both accounts, sanction as well as disbursement, there has been phenomenal growth. Last year, we had sanctioned about 97,000 crore. Disbursement had taken place last year. The current year, in H1 itself, we had disbursed 75,000 crore. Last year's sanction was 2,68,000 crore in the entire year. In H1 itself, in the current year, we have sanctioned 1,95,000 crore. So with this trajectory, I hope that we'll be able to sanction about 4 lakh crore project in the current financial year, and our disbursement will exceed 1,50,000 crore.
There are some parameters where we see negative growth is there. For say, for instance, NII, which has decreased 3.8% year on year if you compare with last year. However, quarter on quarter there is a growth. So, what led to that kind of decrease in NII? And also, if you can explain on cost of funds which has been rising.
Yeah, you have seen that globally this cost of the fund has been rising. The US Fed rate has gone up. Repo rate has been increased by RBI in the current financial year and last financial year. But we have been able to hold on to our interest. Now, we are targeting that our cost of fund, which is about 7.23%, we are targeting to bring it down to about 7%. And similarly, our yield, which was about 9.82% in the Q1, now our yield has increased to about 9.97%. So we would like to maintain this net interest margin of more than 3.5% in the current financial year.
When you say 7% cost of funds, by when we can expect that?
We are targeting that in next 6 to 8 months we should be able to, because what we are doing is that we are taking we are taking diversified borrowing actually. We are taking corporate bonds, term loans from the banks, but what we have observed that our FCNR loan and foreign currency borrowing cost is competitive as compared to our domestic borrowing. So in H1 you might have observed that our most of the borrowing has been from FCNR and external commercial borrowing, and we have been able to do some innovative hedging. So our cost of borrowing from foreign currency is lower than 7%. And similarly, another advantage that we are having, that 54 EC bond, that is capital gains tax saving instrument, there we get at about 5.25%. With the combination of these two cheaper source of fund, we'll be able to bring down our cost of fund to about 7%.
Last question will be there on how much you are raising. You have already announced green bonds. What is the progress on that? And is there any other fundraise which is planned in the current financial year?
Yes, we had raised green bond worth $750 million in the month of April 2023. And we have recently conducted some non-deal roadshow for raising global yen bond. And we are having roadshows in the month of, towards the later part of this month. And we hope to raise global yen bond to the tune of about 300 to 500 million to start with. But going forward, I see huge potential for raising global yen bond.
Thank you so much for talking to ET Now.